New this morning, Morgan Stanley's Mike Wilson saying an end-of-the-year rally for the markets is unlikely. Wilson says that narrowing breadth, cautious factor leadership, falling earnings revisions, and fading consumer and business confidence tell a different story than the consensus, which sees a rally into year-end. Wilson, of course, has been bearish over the last several months and says fourth quarter and 2024 profit expectations are too high, even in an economy that is performing well.
That doesn't in any way describe the last year of Mike Wilson's comments. That doesn't in any way describe it. He finally went
he went bullish.
Finally went
after
less
being
bearish.
Right.
And at the time we said, oh, great, after being wrong for that long. But we did mention he was very tepid in his bullishness, and he raised his price target.
Right, like
which had been 3,200 on the or something like that,
Maybe.
but he raised it to below where the S&P was. So now that's looking. He was a very reluctant convert to being less bearish, which turned out maybe to be right because he was getting less bearish right at the top, and he didn't get overwhelmingly bullish at the top. But the absence of him on this show. When's the last time we've seen him on any show? Has he been? I don't know. Maybe
I don't know that he's
later in the day.
Yeah,
maybe he's been on later in the day. But there's a reason he hasn't been on much. I think we'd welcome.
I'd love to hear. I'd love to hear.
No, we don't expect you to be right all the time.
I'd love to hear from him.
51% is. I think.
But because he's going against the consensus, I'd actually love to hear from him and see what he thinks.
Love to have him on, and even if you were right 51% of the time, we'd give you kudos. We're going to have Siegel on later. He's been right. But he's always bad.
What is it? A 250 batting average you need to be absolutely great?
That's what I've said a few times.
But I'd say 300.
If you can win a batting title, like 300, you're doing pretty well stock picking. Big week for the markets. I'll get to a guy who, but you were bearish for a while. Jeremy Siegel, two-day meeting's going to kick off. Let's bring in Mr. Wharton, Jeremy Siegel, who you had the Professor Emeritus. Oh, we better say that. At University of Pennsylvania's Wharton School of Business. We're going to preview the week. And it's unfair to call you a perma bull. You were bearish for a little while, but in your lifetime, if it was 800 in 1982 and we're now, where we are in the 30,000 plus, it paid to be bullish most of the time, I think, Jeremy.
Oh, it pays to be bullish long term all the time.
Right.
In the stock, big surprise. I'm not in favor of Mike Wilson's prediction here.
You think we will rally? I saw that.
Yeah. I mean, I in a way, I say thank goodness October is nearly over. Actually, in the last 25 years, I looked up the data. November is the second best month of the year, just slightly behind April, which is the first best month. So I do think we're going to have a year-end rally over here coming up. I agree with Roger Ferguson. I heard him earlier on your show. I mean, the Fed is certainly not going to do anything on Wednesday, and they're going to leave the door open. I think it's they're going to just say the evolving data. We still have 6 more weeks until the next meeting. There's no dots this meeting, so we don't know exactly what all the FOMC members are going to be thinking, but it's basically going to be a leave the door open. So I don't know if we're going to get all that much extra information as far as that's concerned. But I was looking at we're 10% off the low. We just entered correction territory for the S&P. We did it a few days earlier for NASDAQ. We're 15% off of that October low of last year. And I went back 50 years, and if that October low holds, which I very strongly believe that it will, returns in the market over the next 1, 2, 5, 10 years are very, very good. In other words, if you can invest 15% off of a bear market low, which is what we had a year ago, your subsequent returns have exceeded the market by quite a margin.
Yeah, I've seen people that have gotten 15% off a low, and then I can remember the actual individual himself. And at the time, I said, you know what? You just called it a multi-year low, and you're getting bearish 15% off the low. That's like stupid, right? And as it turned out, it did go much, much further. So you got to let your profits run, and 15% isn't that much off a low. Do you know what I mean?
Right. I mean, more persuasive than technicals or calendars we're 16.5 times next year's earnings. And he talks about fading earnings expectations. Actually, 2024 is holding in better than historically. As time goes on, usually there's a phase. And, that 16.5 includes the Magnificent Seven. You get out of that and you're really at about 14 times earnings, 13. You get to the mid and small cap, you're 11 and 12. I mean, these are historical lows. Like we saw back in the 80s when, the 10-year was, 12 and 14%. I think we're pretty well near the top on the 10-year, maybe 5.25, but we're not getting up into those levels. And that's the only time that we really saw anything that was like single-digit PE ratios. Exclude that period of time in your 17, 18, 19, 20. So I think valuation is persuasive. I actually think growth is going to be better next year. And I, in fact, think that the higher real interest rates that we've seen is actually more optimism about growth in 2024. And that's going to pressure, the stock market because it has to discount those higher earnings. But I think those higher earnings are going to come through.
That's another thing, Jeremy. You would think there will be, debt will come due for companies and people that thought rates were never going to go up, and there will be some indigestion. But we're just getting back to what a normal rate of return is. I mean, businesses and people have done fine multi-year periods with interest rates where they are right now. This should not be choking off business expansion or business formation or anything at 5%.
Right. I mean, 2.5% is pretty much the average of what those 10-year TIPS bonds have been. Actually, when they were floated in 97, it was 3.5. They went up to 4.5 in 2000. And the stock market hit 30 price earnings ratio, double the level today, which I thought was crazy. And that's when I really, for the first time, turned very bearish there in 2000. But we're a world of difference right now with PE ratios half that number and real yields substantially below. I think we're
in the S&P. We haven't had a high in a while. We haven't had an all-time high in a while, and we've been consolidating and churning around. And maybe that you figure that happens next year.
I definitely think that does happen next year.
Okay.
Yeah.
All right. Well, then you can buy now. Thank you, Professor Siegel.
Thank you very much, Joe.
Okay.
All right, still to come this morning, the antitrust case against Google. Another key witness will testify today. We'll be speaking to former U.S. Chief Technology Officer Anish Chopra. That's next. Squawk Box will be right back.